Fundamentals aren't driving gold this market. Instead, it's the expectations of a Fed rate hike, which means prices can go either way, says our next guest. Joining us from the CME is Bill Baruch of II Trader. Bill, good to have you back on with us.
Hi, thanks for having me on. Thanks for having me on again.
So let's look at gold. The metal slightly higher this Thursday on a weaker dollar, but you say fundamentals aren't driving gold right now. Instead, we're dealing with a very emotional market. What could this mean for the price? More volatility leading up to that December Fed meeting?
Well, what we have is perception kind of leading the way to fundamentals. Right now, perception is pricing in that there will be a hike by December in 2016. You know, as well, on a technical basis, gold broke this massive level at 1,300. The 100-day moving average, the long-term trend line. And when that broke, the doors opened. We saw the commitment of traders that ended on October 4th show a 65.5% decrease, 65.5% increase in short positions. And then as well, long positions by managed money got to the lowest level since the first week of June. This can usually signal bottoming action when managed money does this. You know, what we're also seeing right now is the market finding this little bit of a bottom at a fair value above 1250 as perception has already priced in the Fed rate hike.
So gold's still trading near that and around that 200-day moving average. How's the technical picture looking for the metal right now?
1250.9 is a big level that we're looking at. It's held that. You know, it took a little bit quick stroll below 1250 and then came right back. It ran some stops. But as long as this market holds 1250 on a closing basis, you know, there's a lot of construction going on right here. There's a lot of value in the long term here. We're watching the 200-day moving average at 1264. We need to see a close back above there to encourage further buying. Some resistance around 1283 or so, but really the big level that gold's going to face is about 1300 to 1310 when it gets back up there. But in the near term, it's all about forming constructible technical pattern, and that's closing above 1264.
Now, you have said that we are seeing a similar pattern in gold as we did last year when the Fed hiked rates for the first time in nearly a decade. Could this mean the rally in gold is not over?
You know, what we saw last year was investors and traders pricing in the Fed rate hike before it happened. We had a good payroll number coming in that was released in November last year as well as December. And we saw the gold take a hit as the dollar rallied and ahead of the Fed rate hike. You know, that's exactly what we're seeing right now. The market is pricing in a Fed rate hike. Yet when the Fed actually hikes rates, it's probably going to put some pressure on it. Likely will put pressure on gold. But in the meantime, the market is finding fair value here. Once that Fed rate hike occurs, I do not believe the dollar will move higher much following that until we actually get confirmation we're in a new hiking cycle, because this is not a hiking cycle right now. And then when that occurs, gold will be, the sellers will come in, gold will already be taking its hit, the sellers have already sold. There's going to be a lot of value in gold when this occurs until they can prove we're in a hiking cycle.
Bill, thanks so much for your thoughts today.
Thank you.
And thanks for watching. We'll see you tomorrow.